Welcome back to Turning Hard Times into Good Times. Well, I'm really blessed to have Michael Oliver with me again because as I just was saying on the other side of the break, I don't know of any technical analyst who gives me a better sense of what side of the market I should be on, at least from a longer-term perspective. And that's really important to me because I am not a trader. I do make some short-term trades here and there, but predominantly I'm looking at value, let's say within the gold and silver mining industry. But, as we've seen over the last 4 or 5 years, the stocks can be very valuable, but if the market is going against you, you may as well not be in those stocks. And so to have a sense of whether or not the wind is at your back or if it's blowing into your face is very, very important. And I don't know of anybody, at least from a longer-term perspective, that gives me a better sense of that than Michael Oliver. And I would like to also just mention that Michael, we talked to him about 3 or 4 key markets on this show. But those aren't the only markets that he follows. I mean, I'm looking over the last number of days. He covered Apple. He looked at IBM. He's looked at all manner of other markets: the yen, copper. Just a whole bunch of things that he looks at. We focus on the S&P 500. We talk about maybe some bonds, some treasuries now and then. Most often, gold and silver. But this is a real treasury. A treasure trove that he provides for his subscribers, and just to keep you up to date with where you need to go to follow Michael, it is Oliver MSA, olivermsa.com. Thanks for joining me again, Michael. It's good to have you with me.
Be back, Jay. Good.
I have to think that some of the biggest and best and most successful investors, well, they must be listening to you or somebody that thinks like you, because a number of them are really basically. Well, they're doing now, only now, what you were suggesting they might start thinking about doing a year ago or so when you first started talking about the upcoming plate tectonic shifts. But I'm thinking specifically, and I mentioned in my talk in Vancouver, the likes of legendary investor Stanley Druckenmiller, Peter Fisher of BlackRock, Matt King of Citicorp, certainly Druckenmiller himself looking towards getting out of equities, said it very dramatically in New York about a week or so ago, and getting into gold. And then I hear just today, somebody sent me something along the lines showing that Soros was cutting his equity interest way, way back and piling into some gold equity. I don't remember what it was exactly. So, you recently talked about, you sort of equated the S&Ps to a dead man walking, and the S&P, well, it's getting hammered pretty hard again today, but yesterday was up big. What is your sense as to how much longer this dead man walking can remain mobile?
Well, before I get to that, let me say I'm happy to be on the show with Doug Casey.
Oh yeah,
I'm sure most of your listeners know who he is and all about him. But for those who don't, I've talked to him at length several times over the last year. Over the phone at distance, but he and I share something. I know probably right now maybe 6 people that were active libertarians in wave 1 of the libertarian movement back in the early 70s. And, of course, Doug was foremost because he was the best-selling author at the time.
Yes.
His book, I think, was the #1 financial book of 1980. He's a great guy, and anybody who doesn't know about him, if there were a term I think you'd label him with, he's got a mind that is borderless.
Yes,
and
that's true.
Which is good. Anyway, as far as the markets go, the dead man walking S&P. Most tops in the S&P, if you go back and look at them, are protracted beasts. Long-term momentum will generally give its negative evidence early on, maybe even a year before it goes down. But basically, once the momentum is conclusively broken, and I argue it is, any rallies are for selling. They're nonsense. They're simply and to some extent because the equity markets, the developed equity markets, that is, Europe, Japan, here, are much the target of central bank policy to keep the prices boosted, to keep the faith, so to speak. That sort of explains the ability of those particular markets to hang in there before they finally bust a gut. And this was true in 2000 top. It was true in 2007, 2008 top. There were many actions by central banks prior to and during those topping processes that you can look at and say, that explains why the market won't break. And ultimately, when it does break, because it was exaggerated to begin with by those same policies, it overshoots on the downside. So to some extent, if you're a bear, it's good.
Michael, that causes that whoosh sound that you talk about,
yeah,
right?
the whoosh effect, and I'm sure we'll get it. We got a throttle back in January, but we got one in August as well. But I think we're going a lot lower than the S&P. And by the way, the S&P is, I've said this to my subscribers, is simply not representative of even the developed economy stock markets. It's not even representative of the U.S. stock market. You can look at many sector ETFs and contrast them starkly with what the S&P is doing. S&P is up on the year or unchanged on the year right now. NASDAQ 100, which is blue chip, is actually down on the year 5%. And there's other indices in the U.S. and sectors that are down more than that. So it's really, it's sort of a false god we've created out of the S&P 500, I guess because so many asset managers benchmark against it. But it is not, quote, the market.
All right. Well, you know, it's interesting, too, because we know that the equity markets have been held up to a great extent by companies. In fact, Druckenmüller showed a slide in which a vast amount of money that's been borrowed by corporations has not gone into building plant and equipment, expanding their business, but rather for share buybacks, and which I suppose in many cases allows the management to exercise their shares and take some cash out of the baby, and basically run away with the money in essence and leave the shareholders hanging in the longer term. So, right. But, we like to talk about equities. We like to talk most about gold and silver in this show. But to me, the big one, the real major tectonic shift will be when the Treasury market goes down. And you've started to be a little bit more cautious on long-dated Treasuries, the T-bonds, haven't you?
Yes, again, I don't. I understand the fundamentals. I'm not a bond specialist by any means. I don't care to be. It might confuse me. I look at the technical perspective of any given market via the momentum of its price action. And T-bonds, if you recall, back in 2013, the bond market had a bad year. It was going down sharply. But most bond market analysts, PIMCO included, were looking for higher and higher rates. But our works had not going up, and I'll be darned, it turned in January 14 and has been going up ever since, and has maintained the integrity of what I consider its momentum trend. However, that trend is getting old, it's getting worn at the edges, and I can basically say with some confidence that by the end of this year, that trend will be broken, meaning we're going to have higher rates and lower prices in the long end of the bond market, U.S. government market. I can say that also about the Japanese government bond and the German Bund, the three safest government instruments in the world, quote, end quote, safe. The one I'm watching more keenly right now, though, is in the middle ground. High-yield markets were easy to call a year and a half ago that they were going to drop, rates were going to rise. And now that's a known fact. But during that process, the T-bond, the safe end of the market, has remained steady to up, meaning lower yields. But there's a market in between there that the at-jeopardy, I consider at-jeopardy, government bond markets of Europe, specifically Italy and Spain. So I'm very closely watching their yields and the momentum of their yields, and they have what I consider to be major bottoms in the momentum pattern of their yield action, not the price action, yield action, so we invert that. And it tells me that it's unlikely they'll stay in this bottom for much longer, meaning the yields are going to shoot up. And if you ever jeopardize the integrity of either one of those markets, you've got Greece times 10. They were able to sweep Greece under the rug, and overcome it, overlook it, and kick the can down the road, but they can't do that with Italy or Spain or both of them. And I argue that the next government bond market you've got to watch is not ours, not the Germans, not the Japanese. It's Italy and Spain. They're the ones that will follow high yield into a negative trend or higher rates. And so we're really focused on Italy and Spain right now. And I think once they come unhinged, then probably 3 to 6 months down the road, the other ones will as well. The Treasury.
Yeah, well, that could be the granddad. That would be the granddaddy. I would think that the impact, and that could really be the major energy and force behind that tectonic shift that you're talking about. I mean, that could be the conclusion, I would think, setting things off in dramatic fashion, potentially. We would hope and pray that that's not the case. I mean, who wants to see...
No, it's reality. It should happen because events, lay the groundwork, and you can't, it's just a reality. Objective fact that governments have distorted the pricing of many asset categories.
Right.
And to get back to a normal world, we need to rip that apart again. And I think right now the commodity markets are doing their role, which is acting like a torpedo headed toward the bond markets, because commodity prices are rallying, and they've just begun. And I think it's going to be a very serious percentage increase in commodity basket prices. I'm talking 50% and more in many markets, measured from their bear market lows. I think oil will see 60. Right now it's 48. I think it'll have a wobble at around 50, but I think it's going to 60. Gold's going up. Silver with it. The grains are moving. In fact, we had a limit up day in soybeans last week.
Oh.
And people aren't noticing this because they're so entrenched with their prior template, which is the deflation strategy or view of the world. And they're wrong. The commodities have come unhinged on the upside, and that will be a threat to the bond markets.
Mm-hmm. Yeah, and that could be the thing, the trigger that could send the bond markets lower, I suppose, and probably will. And then, of course, the Fed doesn't want to raise rates, but it might be forced to. Or let's put it this way: I think you would probably be of the opinion that the governments and central banks can try to fool Mother Nature if they want to, but ultimately Mother Nature is going to win, right?
Oh, absolutely. And the longer the process goes on, the longer the non-market pricing has occurred, the more the oscillation has been as well. So not just the time, but time is a factor as well. So the longer the error has been building, the worse the response.
All right, Michael. All right, Michael. We got 1 minute left. Now we haven't talked about gold at all, but the last I saw, you're still targeting something on the order of 1450, 1470, somewhere in that range. I think is the first serious.
Of the year, I think there'll be a sharp wobble in the mid 1300s to come out of this recent congestion. I think if you close any day on the nearby contract at 1290 or higher, which happened to be the high trade of the other day, not the high close though, close the day at 1290 or higher, I think we'll come whooshing up out of this ink that we've been in for the last few months.
All right.
And rush
Very
on
good.
up into the mid 1300s.